everybody. Welcome to this afternoon's webinar. Hope you can all hear me. One of the panel just give me a nod to say they can, I hope. Yeah? Yep, brilliant. Good stuff. Technology is wonderful, isn't it? My name's Steve Sands. I'm the chair of the Information Security Specialist Group at the BCS. It's my great pleasure to while I'm talking, I'm going to be admitting people into the session. So it's my great pleasure to introduce Dr. Adrian Ford, who's going to be presenting to us this afternoon. Just beforehand, though, a very, very quick run through a couple of slides with you. So our agenda today is Adrian's going to speak from about 25 to 1 till about quarter or 20 past 1, there or thereabouts. And then hopefully we'll have time for about 10 minutes Q&A. Adrian's very happy to take questions as we go along today. So if you do have any questions for him about his presentation, then please do feel free to drop them into the chat. And if it's a good time to interrupt him, we will do so. Failing that, then we'll pick it up in the Q&A at the end. So just before we go into the presentation for today, quick welcome and intro to the BCS and the ISSG. The BCS, of course, is the Chartered Institute for IT. We have something in the region of 68,000 members. It's growing all of the time, I'm pleased to say, spread over roughly 50-odd branches around the UK, and quite a number of overseas branches and student chapters as well. We're made up of all of those local branches, but we're also made up of round about 50-odd, thereabouts, specialist groups, of which the Information Security Specialist Group, this one, I'm very, very pleased and proud to say, is the largest. We have something in the region of 3,500 members. In my view, it should be a lot more, of course, because security should be involved in everything that we do in IT. So if you're in IT, as far as I'm concerned, you should have an interest in security. That's my pitch for the ISSG over. So we're concerned with all aspects of both information and cyber security, anything from forensics to hacking to cloud, and just about everything in between. So that's it for the ISSG. Just a little bit on housekeeping, if I may. We've got not quite 120 attendees registered, but I think we've got getting on for 100 attendees registered. So we've opened the chat, and if you have any questions for Adrian or indeed for myself, then please do feel free to drop them into the chat, and we'll try and deal with them as we go along. Failing that, then we'll pick them up in the Q&A at the end. And if we run out of time on that, then we'll try and take a note of them. And Adrian and I will get back to you by email to all of the attendees today after the session. Just for your information, the session is being recorded. So with Adrian's permission, we'll post the recording of it on our website, on the events website. Usually takes about a couple of weeks. So in a couple of weeks' time, you'll be able to go and review it and point it in the direction of other people who might well be interested in what we've been talking about. So that's about it. Final point on that slide, there is no Chatham House for this event. So because it's a webinar and we can't really police who sees it, and because we're recording it anyway, then it's free and open to use how you will. But of course, we would ask you to respect anything that that you hear or that you get from Adrian's slides, and obviously attribute them back to him if at all possible. So let me just introduce Dr. Adrian Ford before we go on any further. He's a cybersecurity researcher at the School of Agriculture, Computing and Engineering at the University of East London, and indeed a freeman of the Worshipful Company of Information Technologists, obviously also in London. So that's about it. Just before I hand over, watch this space for our upcoming events on ISSG. This Friday, we have an early careers event, why young people should consider working in cybersecurity. And we've got two excellent speakers and one of my committee doing a fireside chat on how they got to where they are, what their experiences are, and what it's like getting somewhere in cybersecurity these days. So they'll be talking about their opportunities, their experiences, their learning, and passing on some of that great knowledge to anyone who cares to listen. We're putting together a cloud security program of events at the moment. We've got a joint event with IRMA next week on the 13th, which will be in London. That's a panel session on AI. Everybody's talking about AI. We've got our Legal Day series coming up probably in September or October, and probably some more standards update events. Also trying to get a speaker on quantum cryptography at the moment. So hoping that we can get a professor from Edinburgh Napier University to talk to us very shortly about something that I think is another of those big things that's probably going to change our lives. So without further ado, can I hand over to Dr. Adrian Ford. Adrian, can you start presenting now?
Yes, I will do. Thank you very much for that, Steve. Just give me 1 second while I attempt to do that. Okay. I think that's the one, right? Okay, and Steve, would you just like to confirm that that is now in full screen?
Not yet, no. Just bear with me. That could be because I've got Zoom in the way. Yes, it is. It is on full screen. We can see that. Thanks very much indeed.
Okay, thanks very much. So I've given the title here of my doctoral thesis as a whole. So I think this article was published in the June issue of BCS magazine IT Now, and I gave a short summary of kind of the content of some of my research, which came under the punchy title of security attacks and share prices or something. But I've given it here the full title on the economic impact of information security announcements and event study analysis, which is kind of the formal title of my entire thesis on this topic. So if you Google that, then you can find, you'll be able to find the kind of document in its entirety. Now it is, nearly 300 pages, so difficult to do it justice even in half an hour, but hopefully I can kind of delve into a little more detail than I was able to include in the recent 2-page article. If you haven't seen it yet, then at least you'll get a good feel for what it's all about. Now, although Steve has kindly mentioned a few words about me, I thought it'd be useful just to start off with a bio slide, which has some points of interest. First of all, I wasn't originally an IT person. I actually did my first degree in chemistry in the 80s, but I did, however, read computational science for 2 years, because in those days there wasn't such a thing as IT. It was referred to as computational science. I think the term IT came around later after terms such as management information systems and all that kind of stuff. So I did have a vested interest in IT, and I performed various jobs in the field of chemistry within industry, such as being an analytical chemist and a production chemist right at the coalface, if you will, and then moving into commercial and technical services before they were doing a major system upgrade at the company I was working for. And then at that point, I got heavily ingrained in that, and then never looked back. And then I'd effectively made the switch into IT as an analyst programmer. And although I stayed in the chemical industry for a long time, in fact, I'm still actually working in the chemical industry to date. But I realized actually that after all these years of surviving on a chemistry degree and working in IT, I wasn't really very qualified in the field in which I was working. So I started up doing an MBA. So I concentrated on the business side, but did my dissertation on the adoption of enterprise software within SMEs, and that was kind of my first foray into the academic world after my first degree. And I had that research presented at a conference in Lisbon in 2010, and the content of that was then sufficient for me to be admitted to membership of the BCS, the Chartered Institute for IT, in 2010, based on the strength of that work. And hence the reason I'm here today. as a member, an active member of the BCS, and a participant in the information security specialist group, which of course Steve has given you some information about already. In addition to that, Steve also mentioned I've been a freeman of the Worshipful Company of Information Technologists since 2016, and I'm active in the security panel of that organization as well. And I've also been doing a professional doctorate in information security at the University of East London, and I completed that earlier this year, and indeed the core research of that is what I'll be presenting to you today. So it's some of the content of my my thesis, and so I guess after all these years now I can claim 25, more than, well, it's depressing to come out with the exact number, but it's more than 25 years now of IT management experience in general, and a lot of that, of course, focusing in the area of security as well. Okay, so let me move on to some background. Now, I don't think I need to dwell on this too much because I've used this presentation for a few kind of non-information security specialists as well, but it was just to point out that we've had a lot of high-profile data breaches recently. At the time I was doing the research, British Airways was definitely up there, as was Marriott, and the huge LinkedIn breach. I mean, add to that list now more recent ones, you know, the post office that we've heard about. We've heard about, you know, Facebook issues, and it goes on and on. So this is something which at board level organizations should be taking very seriously. Now, during the course of my research, we also, of course, something happened which I hadn't anticipated when I started off on that journey, which of course was COVID-19, and I guess lots of other people didn't anticipate the huge impact this was going to have. But of course, that also opened the door for cyber criminals who took advantage of this, you know, widespread global communications on the coronavirus, and kind of got on the back of that to mask their activities. So this kind of exacerbated it. And then, of course, you had all of the homework, the sudden tendency to go home working and operating outside of the safety zone of the corporate network. So there was all sorts of additional risks involved there. So again, this brought the issue of cybersecurity to the fore yet again. Cost of cyber attacks has been estimated at 400 billion globally by the Cyber Body of Knowledge in 2022. And there's also been things going on in the environment, new legislation such as the Global Data Protection Regulation, which is now, I know the UK split off from Europe, but it's still relevant. We effectively copied and pasted GDPR, and now it'll evolve as our own kind of version of that, if you like. And indeed, 75% of companies for the UK have reported investing in cybersecurity due to the GDPR requirements, so making sure that they are protecting their personal data, and they have a legal obligation to do that as well. So that's an example of where there've been changes going on in the environment that we need to be concerned about. So I guess as this is the information security specialist group, everyone's aware of the importance of cybersecurity in general, so I won't dwell on that too much. But as part of doing my initial investigation and research into this, I found that there had been a general sort of lack of literature and people reporting difficulties in measuring what a security event actually costs. What is the cost of that to a business? And I found that event study methodology was one of the methods you could use for measuring the impact when it came to publicly listed companies and share price. And I've mostly been involved with publicly listed companies. So, you know, in the event of a security incident, that you will incur internal costs, you know, possibly costs of investigation work, putting it right. There's all sorts of costs involved in to be measured overall. As the impact on the business of that security event. But I was particularly interested in share price, the impact on share price. So, and if you're the CEO of a business, obviously you're going to be keeping a very, very close eye on that. And I wanted to be able to leverage this to help justify business cases for spend, because this is one of the challenges I've had in my career, is trying to convince the board to invest in, prevention is better than cure, as we say. So this has been one of my challenges in my career, and I'm sure other practitioners are experiencing the same kind of challenges as well. I also noted that there was a very strong US bias in studies that have been done of this type, and I thought it'd be useful to put a European spin on things. We also noted there was a lesser proportion of papers reporting the impact of favorable security events. So so most of the literature was focusing on when an organization is hit with some particularly nasty attack, and there's a huge amount of fallout. That's what we might call an unfavorable security event. But the reverse would theoretically apply as well, that if a company has invested in information security, perhaps got some certification like ISO 27000, you might expect that news to be received positively by the market. And we'll come back to that later. The impact of legislation, I mentioned about the introduction of GDPR in 2018. That you would expect to have an impact on the markets as well. And I found that there was a dearth of papers on investment in information security in general. So I wrote a fair bit on that and included a lot of that in my literature review as well as part of the research process. So I developed these aims and objectives. So I wanted to investigate the impact of information security events, be they favorable or unfavorable on the market value of companies, and to see if there are any patterns or correlations that we can deduce, such as what the categories of cyber breach, be it, it might be ransomware, it might be data loss, it may be privacy related, it may be related to different industry sectors, such as, I mentioned the chemical industry, but there's other industry sectors such as financial services, tech sector, and also to investigate whether current regulatory bodies and frameworks for business investment decision making are taking into consideration the importance of cybersecurity. So it was definitely around the comment, a related comment I made about helping practitioners build business cases for investment and convincing the board to make that investment. So my research questions. What was the impact of the share price of a security event, whether it's favorable or unfavorable? Analyze to find patterns and correlations between category of cyber attack and how these can be incorporated into investment strategies. I also wanted to compare that with existing literature to see if it was consistent. And also I had a couple of questions here as well around GDPR. So first of all, what was the impact of its introduction in general from a cybersecurity perspective? And I also noted during the course of this research that there were a few GDPR fines which had been successful appealed or overturned. And I'll also come back to that a little bit later and give you some more information about that. So research method and techniques. My research was very much internet-based, which came out to be a good decision considering COVID. I had to do most of this during lockdown, actually, so I'm glad that I made the decision to do mostly internet-based research. I was lucky in that respect. So most of it was, the data was hand-gathered, looking for data breach announcements, but when it came to GDPR, there was a very useful resource available called the Enforcement Tracker, which lists all of the, almost exhaustively actually, all of the fines which are announced by data protection authorities around Europe. And that's been a very useful resource and saved me a lot of hand gathering information there. I had to filter those cases for those, first of all, which were private enterprises and happened to be publicly listed. So you'll see that the data sets I managed to get in the end were not huge, but I did have to trawl through hundreds and hundreds to filter out all of the government bodies and such like who were reporting breaches and be able to track them back to a publicly listed company with share price data, which was also still available, that they hadn't been delisted or merged. So I only ended up with kind of less than 10% of the cases I'd originally found. It was literally like a 90% reduction in data by trying to filter it down to purely cases where I could analyze the share price. And I decided to analyze the impact on market value using event study techniques, which, as mentioned earlier, seem to be the most popular way of measuring the impact of some kind of announcement on share price. Now, I'm looking at information security events. Other people have used event study techniques quite broadly to measure other things such as earnings announcements, change in corporate directorships and the like. All of these have an impact. You're probably all aware Elon Musk can make a comment and it has a huge difference to the impact of his company's share price. So it was interesting to see and put in context how kind of information security events sit within the spectrum of that kind of impact on market value. So I don't have enough time to talk about event study methodology in general, but just to give you a little flavor of it, what we do is we look back over a company's share price history and how it's changed in relation to a market reference. So if this is, for example, a FTSE 100 company, we measure it against FTSE 100 as a reference, carry out a regression analysis using mathematical methods such as ordinary least squares regression, and use that to predict what the price should be in the future, again based on that reference price. Now, if your actual share price is lower than your expected share price, then that would be an abnormal return which was negative, and such a case which you would expect for an announcement of bad news, such as the company being hit with a cyber attack. Similarly, if the actual share price was greater than the expected, that would be a favorable infosec event where the company has made some positive investment and the news has been well received by the market. So it could go either way. And what we tend to do is we look at the closing prices to measure share price changes. We look at them in the days in and around on and around the day of the announcement, and we tend to look at it day by day. And you don't expect anything to react all over one day. It may react over 1, 2, 3 days, either before, during, or after the event. And we sum those abnormal returns up over that period, which we call the event window. And when you've summed up abnormal returns over a few days, we call it a cumulative abnormal return. And when you've summed up cumulative abnormal returns over a number of different firms for the same time of event, you call them a CAAR, or cumulative average abnormal return. So that's all I'll say on event study techniques, but you feel free to research that in general, and I've also written a big chapter on that in my thesis as well. The parameters used, I used the market model, which was very popular, 120 days, so that's about a 6-month day estimation window to carry out the regressional analysis, and I used the most relevant market index as a reference. I think there are a lot of US studies who tend to use the Standard & Poor's 500. In general, I tended to pick more specific market indexes. So as I mentioned, if it's a FTSE 100 component, then I'd use the FTSE 100. If it's 250, I'd use FTSE 250, etc., etc. I used an R package called Event Study Tools, which was, at the time I started out on this journey, was a public domain tool free of charge, but they've started to monetize that, understandably, now. But that was what seemed most convenient at the time, and I used a market data source of Yahoo Finance. I decided to cap the data at 31st December 2019 because markets started behaving very erratically after that because of COVID-19 effects. It's a fundamental principle of event study methodology that there mustn't be confounding events. So if there's other activity going on in the market in general, or specifically related to that firm, such as earnings announcements, that will of course pollute the impact on share price with other factors. So I wanted to restrict it as much as possible to this the relevant information security announcement. So this involved even more filtering. So once I got down to public listed companies and there was share data available, I had to also filter some out because there were confounding events such as earnings announcements going on at the time that they made the relevant announcement. So the data set was reduced even further. So hence the comment at the bottom that I considered other confounding events as well. So if you want to have a look at my thesis, I can send the link to that later. It's fairly easy to find if you just Google my name and the title. It's on the university repository. But I'm going to focus in this talk on the results from 3 of the core chapters, which I put in the article, which you may have seen in IT Now from this month. So I looked at data breaches, so data breach announcements, but with a particular focus on European markets. There was so much literature out there just focusing on US. And I also looked at any announcement where there's been an infringement fine announced by the relevant data protection authority. And also, so those 2 both can be considered negative from chapters 4 and 5. Chapter 6, I wrote on a company making an announcement of the appointment of a Chief Information Security Officer, or CISO. Now, this you would expect to be received well by the market. So this is what we could call a favorable InfoSec event, where you would expect to see an increase in share price if an organization would make such an announcement. And what I'll do is I will now show you the results I found from each of those 3 studies, and going into a little bit more detail than I was able to go to in the article. So let's start off with the announcement of data breaches. Could be any type of data breach, could be loss of data, could be data privacy related, or could be someone losing a laptop, and any kind of data breach in general, but with a specific focus on European publicly listed companies. So what I found there was the technology sector actually gave the most negative results. So we got almost -2%, but only 4 examples out of a total sample size of 44 security events. And the next largest was financial services, but again, not a huge loss. And unfortunately, the only instance where I was able to show statistical significance was for the consumer defensive sector, where actually there'd been, if anything, a small rise of 1.5% in share price as a result of making those announcements, which you would expect to be received negatively. But the point of consumer defensive is it's supposed to be quite robust when it comes to market movements. So not really as you would expect at all. And not necessarily consistent with all of the US literature. But having said that, some of the US literature did mention that the markets were becoming more, or shall we say, more indifferent, as there are so many data breach announcements going around that they're not quite generating as much excitement as they used to. So I used the market index as a reference. I also did a breakdown by the different markets, and interestingly, I found that the Spanish market had the most statistically negative return. So this is the Iberian market here, of almost -1% drop. Over the 4 examples, all 4 of them exhibited negative CAR on announcement. So just an observation that the Spanish market seemed to be slightly different than others. And I'll come back to that later when I talk about GDPR infringement fines. So overall, I found evidence of a weak negative correlation between the number of records breached and the abnormal returns, which you would almost expect that larger breaches would elicit more negative market reaction. Makes sense, but I couldn't really prove it statistically significantly for such a small sample. I was also able to show that breaches involving sensitive personal data had slightly more negative CAR, although again, it wasn't statistically significant, so it's more a kind of trend indication more than anything else. And overall, the enactment of GDPR had a positive impact on CAR. So when I was looking at breaches announced after GDPR, there seemed to be less negative market reaction, which you might expect as the market's more regulated at that point. financial services sector in Europe seem to be less responsive than US-based studies, and this is something I'll talk about again later as well. So, as mentioned, no clear impact overall, which makes it hard. You know, my goal of kind of helping practitioners justify investment for business cases here, this particular study wasn't that helpful, really. We can say that the market seems to be pretty indifferent in general, except in Spain, as is the next bullet point. And I think it'd be useful to revisit this once the market settled down post-COVID-19. And I also noted there was a lack of a comprehensive database for Europe. So whereas they have privacy rights clearinghouse in the US, this is probably why there's a lot of studies going on market reactions to security events in general in the US, because the data is so easy to get hold of, whereas I had to hand gather it for Europe. There was no such comprehensive database in existence. You know, there's a few small samples, but not anything anywhere near as comprehensive as they have in the US. So you can understand why research is tending to focus on the US for this these kind of studies. So let's move on to GDPR infringement fines. Now here, I did actually find cumulative abnormal returns of -1% up to 3 days after the event, and they were statistically significant, and this was the largest, so around a drop of 1% in share price over those three days. And on average, this is the interesting point here. In most cases, that the loss in market value was much greater than the monetary value of the fine itself, and actually, on average, 28,901 times greater, so nearly 30,000 times greater. So if you're the CEO, you should be way more worried about the impact on share price than the actually paying the fine itself. And in fact, a very small fine, in the case of BNP Paribas, they just had a small €2,000 fine, which I'm sure is absolute peanuts to them, and that dropped not nearly $1 billion off the share price. So the organisation should definitely be looking to avoid having these kind of announcements coming out from data protection authorities. So treat the message here is clear. Treat your data privacy very, very, very seriously. Sectorial analysis was inconclusive in this case, but again, interestingly, Spain and Romania. So yet again, Spain showed significant market reaction when I tried to slice and dice it geographically. With out of a sample of 25 announcements, 10 of them actually belonging to Spain. So Spain seemed to have a particularly active data protection authority, which means the markets are very sensitive there. They issued a lot of fines, closely followed by Italy, and Romania actually came in third. So countries with particularly active DPAs, even though they're issuing very small monetary fines, seem to be having a much bigger impact there, which is interesting. Definitely something we should look at more in future. Now, I did mention that there were a few examples of fines, 4 examples I came across, where the fines had actually been appealed. Now, they'd all been appealed post-COVID-19 because, of course, GDPR only came in 2018 in the first place. So I can't really claim any sort of scientific analysis here, but I just thought it'd be interesting to investigate what did happen, because you would expect if the appeal was positive, that would be a favorable event if the appeal was successful, and unfavorable if the appeal was rejected. Now, all of these, out of these 4 examples, they all went in that direction, as you would expect, except Marriott. Although, bear in mind that they're in the hotel business, and this was during lockdown. I'm sure you can imagine that the market was not reacting well to any kind of news whatsoever concerning that particular market sector. But I think, again, that was interesting. It's an interesting observation, and certainly warrants some future research, definitely, once the market settles down. So what we can say here this time, I did find a clear negative impact of a GDPR fine announcements. So your CEO needs to be taking data privacy very seriously. It highlights the need for businesses to invest in cybersecurity, which is what I was hoping to prove, especially where data privacy is involved, of course, for GDPR. Further analyses were difficult, although we did show Spain and Romania were major contributors to this data set. They got very active data protection authorities there. Results of fine appeals overturned and rejected promising, although inconclusive. And again, let's revisit this data once we get past COVID-19. Results and analysis for the announcement of CISO appointments, which you would definitely expect to be positively received by the market, and a brilliant exactly what happened. So out of 37 events, we found an average abnormal return of almost plus 0.8%, statistically significant at the 5% level. So we can say that we proved that beyond reasonable doubt. There was also indication of information leakage. So I mentioned before that there can sometimes be a share price impact even before this information is made public. So therefore, here I was able to show that it was the event window of the day before, the day during the announcement, and the day after, which is what the -1,1 means, was the most statistically significant change there, which is why I chose that particular window. But it does indicate that there was been some information leakage to the market in advance. So, and this isn't the only case of this kind of insider trading information that's been analyzed using event studies, and there's been evidence shown of this. So that was an interesting point to note as well, that the market knew about some of these appointments before they'd been formally announced. The largest and most significant contributor was the financial services sector. Now, interestingly, of 37 CISO appointment announcements, which I kind of came across randomly doing internet searches, 17 of them were related to the financial services sector. I mean, the 17 out of 37 examples is, it is stand out that it tends to be financial services who are making these kind of announcements and want to shout this information to the market. We noticed also that there were higher abnormal returns from UK and US markets in general. UK were 28 events, 76%. So again, this ended up being a fairly US centric study, even though I was looking globally in general. Majority of the data between 2017 and 2019. The amount of announcements, so the total of the bars, we can't say was, looks like it's remaining pretty steady over time in general, although there's been a peak. The cumulative average abnormal returns have been staying positive over the last 3 years, so we're above zero. This is kind of a relative measure here. So they've stayed positive. It was only really in 2015 when news seemed to receive negatively. So by far the majority have been positively responded to by the market. I also observed a trend towards external recruitment. So people seem to be hiring CISOs externally rather than internally. Although bizarrely, the internal CARs were almost twice that of the externals. There seems to be a benefit in appointing internally, probably because that person already has established relationships within the business and perhaps understands the entire IT environments better and where the risks lie. Percentage of female hires has been fairly constant in the last 3 years. It's good to see that it's sitting around about the 1 in 5 region and getting closer to the 50-50 you might expect. Unfortunately, because the data is heavily skewed because of there's 4 out of 5 being male, then I could only show that male CISOs were more likely to generate a positive CAR. But you would expect that because the data has been so historically skewed. So conclusions for the CISO appointment announcements then. So we can say there's been positive and statistically significant market reaction observed over that 3-day time period, highest in the financial services sector, plus 1.8%, so almost 2% share price increase. And the financial services were well represented in the data set. 46% of those 44 examples were financial services companies. So higher CARs seem to be favored by these, I'm just giving indicative trends here, but if you were going to write, if you're going to craft an announcement to the market It would ideally be for a US or UK listed financial services company. Mention the job title as being CISO, allude to VP or SVP responsibility, so that appointment has real clout in the organization. Don't mention whether it's new or established. It's best not to say that. Perhaps the market's a bit suspicious if you're only just beginning to put a new person in. Hire internally if you can. Unfortunately, because of the heavily skewed data, it would tend to be a male person, but let's hope that's going to change going forwards. And report to either the chief operating officer, the chief financial officer, or the CEO. But interestingly, if a CISO reports to the CIO, it doesn't generate as much interest from the market. And there's an argument there that there's a conflict of interest, because if you're the CIO and you wouldn't really want one of your reports telling you that your environment is not in particularly good shape and has risks. So there's a conflict of interest argument, isn't there, that perhaps the CISO should be independent from the CIO. So uplift in market capitalization could be in the range, I've calculated this in the range of kind of the median to the mean of 94 million to 319 million US dollars. So justifying an inflated salary for a CISO seems to be fairly justifiable here. I think it's very, very easy to build a business case for hiring a CISO and announcing it to the market. And perhaps other sectors should follow the lead of financial services and US regulation, because that seems to be more mature and they're more keen to make such an announcement to the market, because hiring a CISO seems to be good news and it's definitely well worth sharing. Again, this is an area for future research once the markets calm down post-COVID. So overall, I think we've made some contributions to knowledge on this by offsetting this US bias in the literature. At least something's gone, a fair bit's gone in there, especially for the GDPR and the data breaches, which is specific to Europe. And also, at the time I was doing this research, there was very little out there on the introduction of the GDPR in general, so hopefully gone some way to addressing that. There was very little academic literature on CISOs and hiring CISOs, or even what CISOs do. So hopefully that's put some more information out there regarding that. And the lack of studies regarding favorable information as security events. Most people seem to want to focus on the negatives, but the positives will help build business cases as well. It's very easy to justify a CISO's salary just based on the share price impact. Informing company investment security strategy and budget allocation, I've written a fair piece on that in my thesis as well. And overall made a contribution to the application of event study methodology to information security in general. And also, this is the first time that event study tools has been used for, that particular package has been used for this type of study, which made for a useful in comparison with literature. So that's it, I think. And I can now move over to questions. Steve, do you want me to hand back to you? I know you've been keeping an eye on the chat or whatever.
Hi, Adrian. Yeah, I've not seen any questions coming through on the chat yet, but I've got a feeling that they'll be coming through any second now as people start to think about all that you've told us. That was absolutely fascinating. Thank you. And there's some really, really great points in there. So I must admit, I've been carrying my copy of IT Now around with me for a week or so, and I haven't read it all yet. But this particular edition was dedicated to cybersecurity, and you may remember the idea for that came about because the ISSG was going to be 40 this year. So it was a bit of a sort of celebration of the fact that ISSG was 40, and we had an event in the BCS London office last month to celebrate that. But IT Now was sort of focused, this particular edition was focused on information and cybersecurity. And certainly you got in touch with me when I put a call out to the ISSG membership to say, has anyone got any interesting articles that they would like to be published? And thanks to Martin and his team, doing such a great job of it. There's some really, really good articles in there that I want to get to. So I was really interested in lots of the things that you've said, and I've taken a few notes here. I think anyone who works in information and cybersecurity will be particularly interested in the evidence that you've been able to present to back up that assertion that CISOs are very valuable commodities. And any organization that suffers a data breach, one of the things that they probably need to be doing is a bit uncomfortable for the incumbent in the job, if there is indeed one. But one of the things that companies are doing, of course, is getting out the broom to sweep clean, as it were, and bringing in a new CISO. And I was particularly interested that it actually has a more positive impact on share price and valuation in many cases, if that's an internal promotion. Because of that assumption, I think you suggested that there was an assumption that the internal promotee might actually know more about what caused the breach in the first place than bringing someone fresh in from the outside. Have I got that about right? Is that what you were suggesting?
Yes, and it is just an assumption. Obviously, it would require more in-depth research to establish that, and perhaps some interview based research and that kind of thing. But yeah, maybe it's because we can only kind of hypothesize here, but because people have also an established network and also perhaps have established relationships and respect from senior management in the organization as they've been appointed, and they clearly have a voice in the organization, are respected, I think, and that's very important for this position.
Yeah, and that reporting line that you mentioned, so there's been debate over the years as to where the CISO should report. Should it report directly to the highest level of the board, or is it a function reporting into the CIO? And your evidence points to the idea that reporting to the CIO is that does have an impact on the reaction, the share price reaction, if you like, to that appointment. And I think organizations would do well to think about that. Now, we've got a question from Mike Cook. Mike, I don't know whether I can read it out, or you can read it for yourself, Adrian, or I can unmute you if you'd like to speak, Mike. Let me just see how to do that here. Well, I thought I could.
Hello.
Here we are, yes.
Hi. So, yeah, I was just interested if you're saying about revisiting after when things have settled down post-COVID, but is your intention to sort of do some kind of comparison with pre and post? And if so, would you then have to, is there any impact on the current financial climate that might skew your research in any way? So, for example, I know you listed it by different market categories, but as an example, if we were talking about an energy company, for example, I would guess at the moment, energy companies' share prices are quite inflated, given the profits that they are publishing. And so I'm not necessarily saying that energy companies have been targeted by any kind of cyber incident, but if they were, would your analysis sort of take in that kind of impact from the financial side of it, rather than just looking at pre and post COVID as a comparison?
Yeah, I mean, it would be good to kind of do that, but that pre and post. But I also know that I'm working in the energy business at the moment as well, is that the energy business is also very heavily regulated and is subject to much more rigorous standards overall, because it's viewed as critical national infrastructure. So I know there's government bodies getting involved in the auditing side as well. So yeah, it'd be interesting to see how the markets would react to that now, especially considering we're in a very with the the global conflict situation going on at the moment as well, that they're definitely going to be targeted. But yeah, that's something I'd certainly be interested in looking at. That's not something, that I can do right now, but I'd have to, look longer term. And I'm hoping that by publishing this research and with pointers to future research, that someone is going to kind of pick up the ball and run with it, as well. So not just me, but globally. But yeah, I can see it is an interesting sector. There's no doubt about it. But yeah, we need, again, this is coming down to share price in particular, this study. So it has to be a publicly listed energy company. But yeah, as I say, the market is becoming more indifferent to breaches in general. But that was in the run up to COVID. But are they quite so indifferent now? Well, that's another question to be asked, definitely. But I would expect the energy industry to be reasonably robust because of all these additional extra layers of audits which are done and security measures which are in place.
I thought you made a couple of really interesting points there, Adrian. So the notion that the market is becoming indifferent to data breaches is surprising and worrying, I suppose, in some ways. Maybe not surprising when you think about it, because familiarity breeds contempt and all of that. But it is a concern. There is increasingly more and more data, and you would therefore expect and more and more organizations processing that data. So you would expect more breaches of more data because of both of those things, I suppose. But over time, the idea that the world just becomes complacent to data breaches, I think, is probably a little bit worrying for all of us. We've got another question here from MN. MN, I'll just ask you to unmute, but in the meantime, if you don't want to, MN says, could you repeat any comments relating to share price recovery trends, please? This could be either individual organizations or their industry in general.
Okay, so that's an interesting one, actually, because I guess this links into kind of event study methodology, and that we're looking at what the short-term impact on share price is. But there is also something called the efficient market hypothesis, which kind of assumes that ultimately all information will be absorbed and reflected in the share price, and that means that if something negative happens, that negativity will always be there. So the share price will never get back to the level that it was before. It would always have been higher if that negative thing had never happened, if you see what I mean. So the efficient market hypothesis would argue that it never recovers. Even though it gets higher, it will still be below where it should have been, unless you can offset it by some positive news, and in which case you still have that negative impact originally. So I'm not sure if that answers your question, but it's kind of what's negative and happened has always happened, and you can't undo it, basically.
Yeah, that sounds logical. MN, I don't know whether you want to repeat, come back on the chat or.
No, thank you for that. It was just a question of whether any particular activities or full corrections would help the share price, or, as you said, whether it would always be a small percentage below its original target.
Yeah, so a good example would be if an organization had some GDPR infringement fine announced, that it takes measures to take security seriously and appoints a CISO, and then at least they'll get some positive market rally as a result of making that announcement. So you need to offset anything unfavorable with some favorable announcement, or whether it's increase in profits or whatever. But certainly, we've seen the market definitely react negative to certain things, even if it's not just a data breach announcement, but privacy. Obviously the market's taking much more seriously. So yes, in the event it does go down, then you need something positive to offset it, basically. But yeah, you've still got that history there. You never get rid of that, but at least you can be going back in the right direction sooner rather than later.
Interesting. Yeah, really interesting. Something else I picked up on, Adrian, was that I think you suggested that the largest impacts were in sectors like financial services, and I suppose that comes as no surprise to any of us, because the public at large expect to trust certain sectors probably more than other sectors, and financial services that that are holding their money, they will expect them to be looking after their money and their data probably to a higher standard than anyone else. So it's great to see some of these things being confirmed. Have I read that right? Is that kind of what you were implying from your data and your analysis?
Yes. So yes, the financial services sector in Europe I found to be particularly sensitive, not necessarily quite as sensitive as the US, which is even more regulated than we are. But yes, that is one example of where the market does not react well to anything which is involving banks, or things people obviously worry about the safety of their money and such like. And it's interesting, I mentioned the British Airways data breach, is that I was a victim, inadvertently a victim of that myself, because I thought rather than go with budget airlines, I'll go with a reputable firm who we see, let's trust our national flag carrier, basically, and ironically, it was British Airways who kind of suffered the most, so even just if we forget sector and just look at kind of brand value, I mean, there's another potential line of research looking at the perceived brand equity and how secure that company is internally, because again, that's something you would expect to be organizations to be taking data security very seriously.
Yeah. We've got another question. Apologies if I mispronounce this. It's from Nadifri, and I've just
Yes, good afternoon. Regarding your research, you said people are becoming more indifferent to data breaches. So I was asking, does this have anything to do with the class of the data? Because some people classify data like data as like credentials. That would obviously be more important to the end user, as opposed to data as like location history, how many times you went to the nearest shop next to you, those kind of data. So if there has been a breach that the data is not as important to the end user, obviously I feel that this will have an impact on how they perceive it. It won't be a major cause of concern. So, but data is like the very important one, like your banking details, any of those other ones. That is the one that the public usually focuses on, and that's the one that is more common in the financial sector, which is why I feel that the financial sector sees more of an impact based on any data breach that happens. So I want to know, what are your thoughts on this?
Yeah, I think I would agree with you there, definitely. I mean, I've heard expressions such as data is the new oil and all that kind of. So yeah, it's massively important, not just the organization that's processing it, but in the event that it's personal sensitive data, then I think the market would react more strongly. And I think, yeah, I did discover during the data breaches, although I couldn't prove it, I did see a trend that any breach which did involve personal sensitive data was yielding higher abnormal returns than those involving non-personal sensitive data. Now, I haven't taken the analysis to kind of the next level of granularity as to what exactly was it that was lost. I've only just said, was it personal sensitive or was it not? Or was it just general business data? But that's, yeah, I would agree with you that that personal, private, sensitive data is going to yield higher negative market reactions.
Okay, thank you.
I haven't got any more questions for you at the moment, Adrian. So if it's okay with you, I'll just grab the screen back.
Sure, go ahead.
And we'll just start wrapping up because we're heading towards 1:30. So a reminder really for everyone that we've got a whole pile of upcoming events in ISSG. We're still working on the program for this year. It's sort of evolving as we go along. We have monthly committee meetings and we interleave those with sort of program planning and event management and horizon scanning. So the big ones on the horizon right now are the post-quantum that we're trying to get organized, legal day, which will be coming up later in the year. And in the immediate future, we'll be starting on our cloud security program. And we've got the event on Friday of this week, which is Cyber Career Journeys and why young people should consider cybersecurity. I'm guessing that we all know the answer to that because we're kind of in it already and hopefully enjoying it. And trying to keep the damn data breaches down. So, Adrian, that's been absolutely fantastic. Thank you very much. I haven't seen any final questions, so I'm going to draw this afternoon to a close. Adrian, I'll just ask you to hold on the call for a couple of moments, and we'll draw the call to a close for everyone else now. Thank you very much indeed, and we hope to see you at the next one. Take care, folks. Bye.